single thing in the market. Think about a portfolio where you have no limit on how much money you can spend. You basically own every single stock, every single share on every single company that's traded out there, every single bond that's out there, you know, oil contracts, this and that. You basically own the entire market. Okay, that's the market portfolio. Now, the CAPM is based on the principle that asset returns should be such that reward to risk ratio should be exactly the same across all the assets. Reward is measured as expected return on the asset less the return on risk-free assets. You know, very short-term treasury bonds are risk-free, right? There is no default risk, and since they're very short-term, there's no price risk either. Hence, reward for asset I is equal to expected value of return on that stock minus return on the risk-free asset. Risk is measured as sensitivity to the systematic risk as measured by BI, and I'm going to make that a Greek letter. Come on. AKA the asset beta. Where higher exposure to systematic factors or factors imply higher beta. If we view it as a market, when the overall market is going down, certain stocks don't go down as much. For example, in bad times, shares of companies like Coke, Pepsi, sure, they go down as well, but they don't go down as much. On the other hand, shares of companies like Netflix or Google or Amazon, they are affected a lot more. So they have higher exposure to systematic risk. We will normalize these betas by assigning a beta of 1 to the market portfolio, which means we will treat assets as more or less risky in systematic terms, of course, than the market. If an asset or a portfolio is riskier than the market or is more sensitive to market ups and downs, then they'll have a beta of greater than 1. Otherwise, less than 1. We will also trivially let beta of a risk-free asset be 0, because they're never affected by those systematic factors. Which means for any asset or portfolio of assets, diversified or not, you must have expected value of return on that asset minus the risk-free rate divided by beta of that asset has to be the same with the same ratio for any other asset. Since the market portfolio is also another portfolio that needs to obey this rule, we will have I'm going to call that RM beta M. Well, by definition, beta of the market portfolio is 1, right? Since the market portfolio has a beta of 1, for any asset, we must have or rearranging this. Expected return for any asset must be equal to the risk-free rate plus its beta times the reward on the market. Okay. Where we call the market risk premium or MRP. This is, in a sense, an overall price for risk in the market. Different markets may have different price for risk. So overall market requires that much extra premium. So if the risk-free rate is 4% and market risk premium is 8, then that means market portfolio has an expected return of 12 because it earns 8% more than risk-free asset. But all that says is expected return or risk premium for any asset which is expected return on that asset over and above the risk-free rate is a multiple of the market risk premium. That means the only reason a stock would have, if you have two portfolios, the only reason one of the portfolios should have a higher return, expected return, than the other is it has a higher beta. Okay. This means that beta is the only determinant of expected returns over and above the risk-free rates.